Welcome to today's talk. We're going to dive into a subject that's shaking the world of finance and business, the sudden rise in tariffs, a 50% increase. On the surface, tariffs may sound like something distant, technical, or only relevant to policymakers. But in reality, tariffs have a direct and immediate impact on our everyday lives, on the companies we invest in, and on the very stability of the stock market. Imagine tariffs as a toll gate on the global highway of trade. Goods move across borders like cars, and when tariffs rise, the toll suddenly doubles. What happens? Some cars can't afford to pass, others slow down, and traffic begins to back up. The once smooth flow of goods is interrupted. Now think of this toll not as a few cents, but as a heavy weight that raises the cost of everything from steel to smartphones, from food to fuel. That weight doesn't just fall on businesses. It eventually lands squarely on the consumer's shoulders. When tariffs increase suddenly and sharply like this 50% jump, it creates uncertainty. And in the financial world, uncertainty is the greatest enemy of confidence. Markets thrive on clarity, predictability, and a sense that tomorrow will look roughly like today. But when governments begin pulling levers that double costs overnight, confidence cracks, and cracks in confidence often lead to tremors in the stock market. In this session, we'll explore what a 50% tariff really means in practical terms, how it impacts companies, industries, and global trade, why the stock market reacts so sharply to these changes, the psychology behind investor fear and panic, and most importantly, how to think long-term when short-term chaos takes over. By the end, you'll not only understand why markets tremble in the face of tariffs, but also how to remain calm and strategic when everyone else is panicking. So let's step into this world of tariffs, trade, and turmoil. What is a tariff? A tariff is, at its core, a tax on imports. Picture a merchant who imports coffee beans from overseas. Normally, those beans cost him $1 per bag. If the government imposes a 10% tariff, he now pays $110 per bag. That extra $10 is not going into the farmer's pocket. It's going to the government. Now imagine that tariff jumps to 50%. Suddenly, the $100 bag of coffee costs the merchant $150. Do you think he will absorb that cost out of kindness? Not likely. He'll pass it on to his customers, cafes, grocery stores, and eventually you and me buying our morning cup of coffee. This is the essence of tariffs. They raise the cost of goods, making imported products more expensive. And while tariffs are often justified as a way to protect local industries, the hidden cost is that consumers end up paying more. Businesses face thinner margins, and global supply chains get tangled. A 50% tariff is not a small policy shift. It's a massive shock. For context, most tariffs in developed economies are single digits. Moving from 5% to 50% is like turning a gentle breeze into a hurricane overnight. Immediate impact on businesses. Companies that rely on imported materials or finished goods suddenly find their costs exploding. Let's take a few examples. Electronics. Imagine a company that imports computer chips from abroad. Those chips cost $1 billion annually. A 50% tariff means the cost jumps to $5 billion. That $500 million gap either reduces profits, raises prices for customers, or both. Automobiles, car manufacturers rely on global supply chains. Engines from one country, steel from another, software from yet another. When tariffs rise, assembling a car becomes far more expensive. Either the sticker price goes up, or the manufacturer takes a painful hit on earnings. Retail clothing, furniture, toys, many are made overseas. A 50% tariff makes them costlier. Retailers already operate on thin margins. They cannot simply double prices without losing customers. so many are forced into survival mode. Now, consider the ripple effect. Small businesses that depend on imported parts may shut down. Consumers cut back spending because everything feels more expensive. Exporting countries retaliate with their own tariffs, making it harder for domestic companies to sell abroad. It's a domino chain, and once the first piece falls, the momentum builds fast. Stock market reaction. The stock market is not just numbers flashing on a screen. It's a reflection of human emotion, fear, greed, optimism, and panic. When tariffs rise 50%, here's how the psychology plays out. Investors see costs rising for companies. Profits are squeezed. Lower profits mean lower earnings per share. Stocks lose value. Traders anticipate consumer pullback. If goods are more expensive, demand falls. Lower demand equals lower revenues. Retaliation fears. If one country raises tariffs, others respond. Suddenly, global trade, the lifeblood of many large corporations, starts shrinking. Markets hate surprises, and a sudden 50% tariff increase is like an earthquake no one predicted. The ground shakes, investors rush for safety, and stock prices tumble. History shows that when tariffs rise dramatically, markets often enter periods of volatility, with wild swings up and down. Some sectors like technology, retail, and autos are hit hardest. Others, like local agriculture or domestic manufacturers, may temporarily benefit. But overall, the uncertainty drives investors to pull money out of stocks and into safer assets like bonds or gold. Long-term thinking here's the important truth. Tariffs and trade wars are storms, but not permanent climates. They cause damage, they uproot confidence, but over the long run, markets recover. The key lesson for investors is to distinguish between noise and signal. Tariffs are noise, loud, disruptive, even frightening. But the signal is the underlying strength of businesses, the durability of demand, the adaptability of entrepreneurs. When fear grips the market, prices often fall below true value. That's when disciplined investors quietly step in, buying strong companies at discounted prices. The market punishes short-term panic, but rewards long-term patience. This doesn't mean ignoring the risk. It means recognizing that while tariffs may shake the tree, the strongest branches still bear fruit. The world economy is too interconnected, too dependent on trade, for barriers to last forever. Eventually, pressures mount, negotiations happen, and balance is restored. Practical guidance for investors: stay calm. Panic selling locks in losses. Focus on fundamentals. If a company has strong balance sheets, loyal customers, and durable products, temporary tariffs won't sink it. Diversify. Don't put all your eggs in one industry. Spread across sectors and even geographies. Use volatility wisely. Market crashes are painful, but they also create opportunities to buy great businesses at a discount. A 50% tariff rise is not just a line in a policy book. It's a shockwave that runs through factories, shops, households, and the stock market. It raises costs, rattles confidence, and often triggers market crashes. But history also teaches us that crashes are not endings, they are resets. The market always finds its footing. Those who stay disciplined, patient, and focused on long-term value emerge stronger when the storm passes. In times like these, the lesson is simple. Don't let fear dictate your decisions. Tariffs may rise and markets may fall, but strong businesses, wise strategies, and calm investors endure. So, while others see a crash, you can see an opportunity not to gamble, not to chase trends, but to invest steadily, rationally, and with the patience that always wins in the end.